Welcome back. Shares of Disney are lower today on the back of a downgrade from Cowen. The firm arguing COVID impact on the company's theme parks and film businesses could last longer than Wall Street expects. With us now is the analyst behind the call, Cowen's Doug Kreutz. Doug, great to speak with you.
Thank you.
You actually don't expect to return to pre-COVID levels until 2025?
Yeah, for the parks business, I kind of look at this as there's two steps here. One is getting the parks fully reopened to back to capacity. But then if you look at prior recessions, Disney has historically cut price in order to protect volume, and it takes about 3 to 4 years for them to recover those price cuts and get margins back to kind of pre-recession levels. So even after we can get the parks fully reopened, there's going to be kind of a normal recession-driven margin downturn that will take a few years to get back.
Are you seeing evidence that they're going to have to cut price right now at reduced capacity? I mean, the head of the parks had said something to the effect of he was pretty pleased with how the bookings have gone so far.
Yeah, I think you've got, some pent-up demand, and as I said, capacity is relatively constrained. Mm-hmm. I think it's also a lot of local visitation. So, they're not necessarily trying to book out the hotels right now. It'll be more when you've got a fully open park and potentially, an economy that's still in tough times that they may feel the need to cut price to preserve volume. And historically, that's what they've done. So
what's interesting in how Disney and a lot of the other sort of stocks that depend on crowds basically to go and frequent them is whenever there's positive news about a vaccine or a treatment, Disney stocks rally. But you're saying essentially that even with the vaccine, it's not a flip the switch sort of scenario in which demand returns overnight, that there's still the lingering impact of the job losses, let's say, in the economy.
Correct. Yeah, I mean, it's interesting. I also cover the video game space, and that's a big play on sort of we're not going to get a vaccine. And on a lot of days, the media stocks will be up and the video game stocks will be down. And the next day, the video game stocks are, right, they trade opposite to each other. And certainly we've seen, as hopes of a vaccine have increased, that there's been some rally in the let's say, crowd stocks. But like I say, there's an economic impact here, too, which you can't understate, and that's likely to be persistent for a while. Now, the film business, which we also took numbers down because we're now assuming they don't release any films this year at all, that should come back pretty quickly once theaters are reopened.
Okay, so it's really the theme park business that's going to suffer and pull Disney down. In terms of Disney Plus, the bulls will say, Netflix has a certain valuation. Shouldn't Disney have a little bit of that valuation to offset that weakness in the theme parks, even though parks are a much bigger percent of revenues?
Yeah, and certainly when we upgraded Disney a little over a year ago, our thesis was that Disney Plus was going to get off to a fantastic start, and it has. If you look at Disney compared to its media peers, Disney's trading at an EBITDA multiple that's 2 to 3 times companies like Viacom, CBS, or Discovery. So I would argue it is getting at least something of a Netflix type premium in its valuation at current levels.
So, Doug, earlier today, Attorney General Barr went after several big name companies and named them by name, including Disney, for being too close and too tight with the Chinese, and specifically with the Chinese Communist Party members. And he was basically increasing the heat on those companies to change their practices and not risk their intellectual property, of which Disney has a lot and are very aggressive defenders of their intellectual property. Are you worried about Disney's business in China?
Not particularly. They do partner with the government there. They have a theme park in Shanghai. They have another in Hong Kong. They have, they do a lot of box office in China, and they are very defensive of their intellectual property, as you pointed out. The fact that tensions between the U.S. and China are increasing is a potential problem at some point down the road. But as of right now, I don't think it's a serious issue for the company.
How long can ESPN go without live sports, Doug?
Well, ESPN is part of the basic cable bundle. And so as long as people, continue to subscribe to cable for all the other shows that are on cable, including CNBC, then ESPN will have subscribers. Now, we have seen cord cutting increase since the pandemic started. And I think the lack of live sports on television probably is a factor on that. it'll be interesting to see as sports comes back if we see some subscriptions come back as well. I think the live sports issue is certainly a bit of an issue in the near term. The longer term issue is just the health of the cable bundle overall. And that's one area where we've always been cautious, even when we were positive on the
And I
stock.
would imagine the softness in advertising. I mean, if you're expecting the lingering impact of the pandemic is people, consumers cutting back, corporations are certainly cutting back as well.
Yeah, and we've seen a big pullback in ad spend.
Yeah.
We had cut our numbers for that several months ago. We didn't do any further cuts today because it's harder to see exactly how that trends. But certainly, if there is a prolonged recession, you would expect to see a prolonged decline in advertising as well.
All right, Doug, great to speak with you. Thanks for your time.
Thank you.